Felix here, if you've just looked at the market, it's tanking. Why? The jobs data is in, and you need to understand what the macro is behind it, what it means, and what it means for the rest of the week and the rest of the month and the rest of the year. That's what I'm going to explain to you here. Old economist, former banker talking. Before we do that, I'd encourage you to download this free benchmark. It's Goldman's top 20 hedge fund stocks, the top 20 stocks that most hedge funds bought into of late. Felix.com/top 20. Download it. It's free. And of course, none of financial advice. You know that by now. And you also know that I struggle to get the right screen to display occasionally. Here it is. So what am I going to talk to? Well, we want to look at this data here. And I did warn you, if you've been watching me, that this is going to be a pivotal event for markets. Jolt openings is the key figure here. It basically means job openings. Now, it's much easier as an employer to not hire somebody or to put a job ad out, so you respond much quicker. These numbers respond much quicker to the state of the economy than actual unemployment figures because it takes time to hire or fire people. And we were expecting 10.5 million job openings, and that was meant to be less than last month, right? We wanted it to decline because the economy is declining, and we got 11.24 million instead. It's gone up by a whopping amount. Is that good for the market? No, it's terrible for the market. Terrible for the market. Consumer confidence, we were expecting it to be about 98, 97. What do we get? We got 103. That's gone up. Is that good? No, it's bad, because we want the economy to tank once and for all so that the Fed gets its signal. You can do your job elsewhere now. You can outsource. You no longer need your rate hikes are going to come in softer. And therefore, the worst is kind of priced in, and in the market it's going to recover. Now, when do people quit their job? When they hate their job and they found a second or third income stream because they become marvelous options traders. Well, maybe that's one time, but most of the time people quit their jobs because it's really easy to get a new one and maybe they can get a higher paying one. We were expecting that number to be less than it was last month, a decline. So we were expecting, what did we get? Yep, another great big arrow upwards. We got more people quitting their jobs, which just means the economy, the labor market is still hot red, and none of that stuff's good. None of that stuff's good. Fed Services Index, again, an activity measure of the services sector. We're expecting that to be minus 15. We're expecting to be worse than last month. And guess what? It's like 3 times better than expected. So all of these numbers are good if you live in the real world, and they're terrible if you're stock investors. I know it's all upside down. But really the only thing that is actually slowing is the housing market. Up here, the housing market is slowing. House price index is slowing. Home prices are slowing and all of that. Okay, that's all kind of nice, but we kind of expect that already. So we really wanted these job numbers to come in and look very different to what they look like right now. If you want to see how the market reacted to it, this is when it happened. This is the 4 o'clock announcement. It's my 10 o'clock. I'm in Paris time. And in red and green is the market, and it's tanked since then. This is the QQQ, 1.5 percentage points. And if you look at the VIX in orange here, which is the fear indicator, crikey, it's gone off the charts. That's how far up it's gone. There it is. That has gone up since by also 1.5%. So this is the market screaming, crikey, what the heck's going on here? Fed, you're going to have to raise rates much higher, much faster. What else are we going to look forward to later in the week? Well, we are going to get some Thursday jobless claims, continuing jobless claims, and the 4-week average jobless claims. But that data is a little bit more slow. Initial jobless claims also. That's a little bit slower. And then on Friday, the unemployment rate, and it all might sound like it's the same thing, but it isn't. Also, average hourly earnings will tell us. We want that number to, again, slow. So to see what payroll is looking like on Thursday and Friday, watch out for that. But really, this was the biggest event of the week, and it's gone really in the wrong direction. If you look at some of my options trades here, 2 of them are looking marvelous. DocQ, because we were bearish on that trade. Not that we particularly care, because we are essentially market neutral. RCL here was also trade. It's also bearish. That's doing very well. Probably be able to close that out later today. And then the FCX trade looks like it's going against me, and it is. But we still actually 5.8% down. We could fall to 28.80, so we could fall quite a bit more here, another 5% or so, before we actually lose money. So again, really important. It could have it can go 10% against the direction I thought it was going to go in, and we still make money. So that's how we trade. We never just say, oh, it's going to go up, it's going to go down. No, we think it might go up, but if we're wrong, it can go down 10% and we still make money. That's how we set these up. And that's super important to understand that. So to learn how we do that, check out this felixfriends.org/options. It's my options program, about 100 lessons plus weekly. You get to see me trade live. You get to see those trades that I just made there. I did them on Sunday, actually, live, where you guys to watch and learn from the experience. And so it's about strategy. It's really not about understanding the technicals of options. Like you could really literally buy a book. But the book is not going to help you because, unfortunately, most people who trade options in the retail world, they buy call options, they buy puts, maybe they sell a put, they do covered calls, they do the wheel thing. None of that really makes you a lot of money. Definitely not in the long run, because it only ever works in a particular kind of a market. We're market neutral. We use basically the strategy that Wall Street use, that big traders use. And that's what I teach you. And that's what makes us these marvelous returns. We're up 123% or something like that on the year so far. Let me open it up for you. Transparency is always super key. Anybody you ever learn anything from, ask for transparency. That's super, super important here. 123% up. So for August, we're up 12%. July, we were up 12%. Nice consistency, right? June, we're up 13%. So we make that money in that month. This is not annual, right? So each month we're making double-digit returns, with the exception of April, which was a pivot month. We changed strategy a little bit because the market went truly bananas that month, but we still make money, right? That's the key thing. The market tanks and we make money. So that's really what I teach you. So check it out. Links down below. And that's it pretty much from me. If you only want to do one thing and one thing only, then watch this one here to really understand what the heck's going on in the market. I aim to make all of my videos as educational as humanly possible. So click here.